Today, we're tackling a question that I see all of the time. How do people with millions of dollars in savings still end up struggling in retirement? It happens more often than you'd think, and it usually comes down to just a few critical mistakes. As a chartered financial analyst and a partner of a retirement planning firm, I've seen firsthand just how easy it can be for even well-prepared retirees to mismanage their wealth. Building a $2.3 million nest egg is a huge accomplishment, but managing this money so that it lasts for the rest of your life, that's a different challenge entirely. In today's video, we'll walk through a case study of a hypothetical couple who thought they were set for a comfortable retirement, only to find themselves facing serious financial concerns just a few years in. Let's get right into it. So Mark and Lisa Doe are both age 64. They're recently retired and they have a combined $2.3 million saved, split between tax-deferred retirement accounts, taxable brokerage accounts, and cash. They've done a great job saving, they've paid off their mortgage, and they have no debt. Their game plan is to withdraw $150,000 per year from their portfolio while collecting Social Security later in their 60s to maximize their benefits. It seems reasonable, right? But let's take a look at their portfolio and then show how their investment oversight changed everything. So we know that Mark and Lisa have $2.3 million in financial assets, excluding their house, which we're ignoring for retirement cash flow planning purposes because they need somewhere to live. Of the $2.3 million, they have $1.6 million spread across various retirement accounts, and then the remaining $700,000 is split across some brokerage accounts and the savings that they have in their bank. If we take all of their money and break it down by investment category, we can add these numbers up to understand what their overall asset allocation is, which in their case is roughly 60% allocated in stocks and 40% allocated to bonds and cash and money markets. Of the 60% they have in stocks, they have roughly 80% of that 60% in large growth stocks. Growth stocks tend to swing more to the upside and to the downside during good and bad times. They have roughly 8% in value stocks and the rest is in a blend. Of the 40% that they have in bonds, they have around $100,000 in cash, $50,000 in short-term bonds, with the rest of their bond money spread across longer-term and higher-risk bonds. Now let's start by taking a look at what's required of their savings to maintain their lifestyle. So we've established that Mark and Lisa need $150,000 each year to sustain their lifestyle in retirement. They're 64, so that leaves them with 3 years until Lisa turns on her Social Security and then 6 years until Mark turns on his at 70. They've determined that this filing strategy strikes a healthy balance between hedging against longevity and realistically maximizing their lifetime benefits. So for their early years of their retirement, they're relying exclusively on their portfolio. I'll start by saying that this isn't necessarily a huge deal as long as you consider it thoroughly, and it's really not all that uncommon. But in the early years of retirement, based on their need for pulling out $150,000 a year, their burn rate, which is just the amount that they're withdrawing each year as a percentage of their total financial assets, is around 7% until Lisa's benefits start. Then it drops to around 5.5%, and then finally it drops well below 4% once they're both collecting Social Security benefits. We'll also bake in some conservatism to our other assumptions that we're making by assuming that their Social Security benefit cost of living adjustments end up being about 0.5% less than what their actual spending is rising by each year. And we'll assume that average taxes in America rise slowly over the long run, which is a reasonable assumption to make over a long period of time. But to gain more control over our spending assumption, we'll assume that their retirement spending smiles over time, where they'll gradually spend less as they age into retirement and then eventually spend more in their later years as outlier healthcare and potential custodial care needs become more likely. Based on all these needs, in a world where the portfolio increases linearly, which means that it rises by a constant amount each year, in this case we're assuming around 6%, their money lasts until they're 103 years old. Not bad. But of course, the reality is that markets don't move in a straight line. So let's see how their plan holds up through a more realistic lens. To do this, we'll run a Monte Carlo simulation, which is just a fancy word, which means that we're assuming a random return each year based on the volatility of their mix between stocks and bonds. By doing this, we can take advantage of the law of large numbers to see a reasonable range of potential outcomes and calculate a probability that they'll have to make adjustments to their spending in retirement. In their case, there's a less than 5% probability that they'll have to further adjust their lifestyle by their mid-80s, but in the average market scenario, scenario, their money's getting out towards age 100. So all in all, a pretty good outcome. But let's highlight Mark and Lisa's first mistake. The stock portion of their portfolio, which represents about 60% of their total financial assets, is concentrated to high growth stocks. Growth stocks which have performed very well over the last decade and a half. So their primary retirement risk has to do with A, timing, and B, potentially higher volatility on their stock investments. This is known as sequence of returns risk. Sequence risk is when somebody retires on the eve of a period where stocks experience tremendous downside volatility, forcing them to spend off of a shrinking base of money and essentially compounding their wealth in reverse. To help visualize this risk, let's assume that they retired on the eve of the dot-com bubble at the turn of the millennium. If you're watching this video, it's likely that you experienced the dot-com bubble, but as a refresher, from the years 2000 to 2003, growth stocks were halved, with some companies either failing or erasing over 80% in value. I don't say this to say that we're in a bubble today, because today isn't 1999. But the point is, some stocks offer potential for higher returns, but with that comes the potential for greater downside volatility. This reality is magnified for retirees who are spending off their money and need that money to last. So had they retired in 2000 with their current mix, their money would have been projected to run out or approach zero by the age of 84, assuming no other changes to their spending. Now let's assume the opposite, with their stock allocation invested 80% in the market-weighted portfolio and 20% in US growth stocks. Now their money is projected to last until the age of 90. That's a difference of 6 years, and that's simply comparing different types of stocks. Now let's look at if they retired in 2009 after stocks bottomed post-financial crisis, shifting the focus away from the diversification within stocks argument and towards simply bad timing. Now their money is projected to get out to the age of 135. But you get the point. Diversification is so important. On one hand, most Americans need to have a portion of their money in stocks to help grow their longer-term money by enough to safely fund their spending needs. But the question is, how much should you have in stocks, and what type of stocks should you have? Later in the video, I'm going to cover what Mark and Lisa could have done differently to better manage their retirement risk. But if you're at all concerned about where you currently stand for retirement, click the first link in the description of this video, answer a few questions on my website, and I'll send you a personalized video sharing my thoughts about your financial situation and goals. Now moving on. The second mistake that Mark and Lisa made was in how they structured their bond portfolio. If you remember, they've set aside some funds to ensure that their near-term spending needs are met. They've got about $150,000 spread across cash and short-term bond investments. So if things get hairy, they can have capital that they can withdraw without having to tap into their riskier investments that might be down in value. But they're spending $150,000 per year and will need at least $1 million from their portfolio over the next decade. So clearly, this could create some problems should markets experience a suboptimal outcome. I see this a lot because retirement plans offered by companies tend to only offer mutual fund investments. This isn't necessarily a big deal, but what I find happens is that investors get familiar with bond mutual funds and lose sight of bond-related risks. For example, if market interest rates rise, bond market prices fall. So when you own a bunch of bonds inside of a mutual fund, if market rates rise, your shares of the mutual fund fall. Although it's highly unlikely to be as serious as when stocks sell off in a down market, it's downside volatility, and for retirees who constantly need to take from their portfolios, it's generally wise to have some predictability. Now let's talk about what they could have done differently. Mistake number one, Mark and Lisa could have structured their stock portfolio differently to reduce their risk while still maintaining growth potential. Their overall 60-40 allocation seemed reasonable, but their stock holdings were highly concentrated in growth stocks, making their portfolio riskier than it appeared. Growth stocks have historically performed well, but that doesn't mean that they have to. And when they underperform, they don't care Mark and Lisa just retired. Instead of relying so heavily on one type of stock, Mark and Lisa could have diversified by including less exciting investments, maybe some dividend-paying stocks. They don't need to sell all of their growth stocks, but just diversify further. Another issue was their 100% US stock exposure. While there's nothing inherently wrong with having a home bias, Mark and Lisa could have benefited from diversifying globally. International stocks don't always move in the same direction or to the same degree as US stocks, so adding exposure to other markets across the world could have helped them lower their overall risk without necessarily sacrificing their longer-term returns. Mistake number two. Mark and Lisa also could have structured their bond portfolio differently to provide more stability. Instead of relying exclusively on bond mutual funds, they could have carved out a sleeve and moved it into individual bonds to create more predictability over the near term. Bond mutual funds don't mature like individual bonds do, which means that their value will fluctuate with interest rates. If rates rise and Mark and Lisa need to sell, they could be forced to sell and take losses. Owning some individual bonds, on the other hand, would have allowed them to hold each bond until maturity and receive their full principal back along with predictable interest payments. A more thoughtful approach could have been to carve out 3 to 5 years worth of their upcoming spending needs from their bond portfolio and then move it into a guaranteed bond ladder, which is a strategy where bonds are purchased with staggered maturity dates so that the money is consistently available when it's needed. This would have helped them avoid selling assets at a loss and ensured that they had steady cash flow to cover their expenses, even if markets were down. Mark and Lisa made a few common mistakes, but the good news is that they could have made adjustments to better manage their financial risks. By diversifying their stock portfolio and securing a portion of their bond investments through a bond ladder, they could have improved the long-term stability of their plan. If Mark and Lisa's situation sounds familiar and you're wondering how your own plan holds up, click the first link in the description of this video, answer a few quick questions, and I'll send you a personalized video breaking down where I believe you stand. I'll see you in the next one.